Now, IDFC First Bank is in focus as well. Vaidyanathan, Managing Director and CEO of IDFC First Bank. It posted second quarter earnings. Asset quality took a hit, unfortunately. Let's hear him in conversation with my colleague.
So this was a bit of a freak incident that happened because the concerned state government made toll free. So our client for entry and exit out of Mumbai, and our client got stuck in the midst of this. It's a force majeure incident that happened. By the way, this client, our exposure was 1,100 crores when we started maybe 5 years ago at the time of merger. This was an account coming from pre-merger times. It came down to 500 crore, or 480 crore. But last, it was still paying. But now, because of this incident, we know they can't service the account now. And we never know when the state government is going to settle this issue with the client, etc. So we didn't want to be hostage for the future profitability of the future quarters. So we took it all upfront. We've taken 100% provision for that account. And that took the profit down by 250 crores this quarter.
What about the microfinance portfolio? So there, multiple banks have come out, banks as well as NBFCs have come out and said that there's been some slowdown, especially in the eastern part of the country, districts showing some amount of delinquencies coming in, largely led by election-related movement. If you can just throw some light as to what your portfolio is looking like.
So we too have an exposure to microfinance. It's a very important part of the priority sector book of the bank. It meets multiple kind of priority sector, weaker section priority sector, small marginal farmer, and so on. So it's an important sector for the bank, and we have been doing this business for 7 years. But of late, there is a stress in that sector for the last maybe year or so, but accentuated recently. It came from heat wave, it came from floods in Tamil Nadu, it came from elections, some promises of waiver, etc. So confluence of many things came together, a bit of over-leveraging and so on. So we saw that last 3 quarters at a stretch, our pre-NPA stage, that is SMA 1 and SMA 2, that has been inching up very sharply. It was like 1.27, now it already touched 2.5 within 2 quarters. So we are like this only. We always take our issue directly. We don't find cute solutions around those matters. So what we did was that normally at 90 days past due, our bank takes 75% provisions, even normally. And at 120 days past due, we take 100%. This quarter, because seeing the stress in the sector, we've advanced that number and we've taken close to 100% provision or 99% provision at the 30 days past due itself. So we just accelerated it so that we just want to recognize the true stress in that sector.
Ahead then, from your road account, of course, there's unlikely to be any stress because of the 100% provision. But from microfinance, is there anything further that you're expecting?
Whatever flows subsequently happens from now on, it'll come. But because we already recognized this issue early on, our flows into a delinquent bucket should be relatively lesser from now on.
Right.
So therefore, in the next quarter, you should see some improvement.
Sure.
Yeah, sorry.
Sure. I also wanted to touch on the credit card book. At this point in time, you are not seeing an elevation in your delinquencies. It's stuck at about 1.4% on the 90 DPD. The industry started seeing that sort of rise in delinquencies. Are you looking at cutting down exposure there on the credit card portfolio?
See, it's very important to understand how a credit card sector is built. And I'm actually happy you asked this question so that I can explain to everybody. In the credit card segment, as you can see from numbers, we have put out the civil TransUnion data about what 30 DPD, 90 DPD delinquency is. We put out our data, and we're significantly lesser in terms of NPA, 30 DPD and 90 days past due compared to the industry. Now, there should be reason for this, for this to behave well. The key reason is that we are lending our credit cards largely to our own customers who are on the savings account side.
Okay.
And our bank is on the savings account side attracting slightly higher end customers. Our average balances are much higher. So since the profile of the customer on the liability side is a slightly higher income profile, and we give credit cards to them, by definition, therefore, that our portfolio is behaving well. We don't intend to change the strategy. We'll keep growing, but we'll be very cautious because we're seeing the numbers of the other players. We will check and double check our practices, our underwriting once again.
Would you say that this applies for a broader unsecured space as well? Are you turning cautious as far as that is concerned?
Of course, we are very cautious because we got very cautious. We are always cautious, but about a year and a half ago, we became cautious on this segment because the regulators started talking about it again and again. So we went and tightened all our criteria, and we're happy we did that. Today, our unsecured book is 15% of our book on the retail unsecured. Sure. And the the retail unsecured plus consumer durables plus education loans, which is a specific end-use financing, which is also unsecured. That segment put together, our gross NPA is 2.03% and our net NPA is 0.5% only.
Okay.
So we have our SMA, the leading book towards unsecured, is also only about 1.09%. So our unsecured book is behaving quite well, but we'll be cautious. We don't. Even our employees is hearing the program. I don't want anybody to get complacent.
Got it. Coming to the liability side of the story, now you've seen a strong deposit growth, 32%, if I'm not wrong, year on year. Considering that the industry, I know we spoke about this about a year and a half ago when you were announcing numbers. At that point in time, again, this problem was very evident, and it doesn't seem to have gone away. I wanted to get your view on what it means for the industry going ahead, if there's going to be a lot of competition, and then for IDFC First as well, if finding fresh customer deposits is becoming a challenge or not.
We have been studying this again and again. As you know, last 5 years at a stretch, we have focused a lot on liabilities, on deposits. We needed lots and lots of deposits because we had, a back book to fill. So we are experienced in this space. Now, in our case, even now, Vishwanath, our deposits are growing by 32% YOY, 32%. And by the way, we have only, we are like about 960 branches, but our deposit inflow is very strong. Last quarter was also very strong. So the point to note is therefore that we are now beginning to feel that service is a very big factor and the technology is a very big factor. Our app is, you must try it if you haven't yet. So we are not increasing interest rates, but still deposits are growing by 32%.
I want to close this up with a question around your margins. At this point in time, there's been a slight dip. I mean, one can understand because of the provisioning that you've made. So obviously that credit cost is eating into some of your margins. But could you give us some kind of guidance what the rest of the financial year, the last 2 quarters are going to look like?
Margins should broadly be in zone. We'll have to play it quarter by quarter because too many moving parts are here. But give or take the 6% plus should be there. And since we're closing the interview, I must mention one thing to you, Vishwanath, is that in this talk about provisions, this, that, etc., there's so much of attention is spent on this, and therefore we couldn't. There is some core franchise that is coming very strong. Sure. Our one deposit we talked about, but our wealth management business, we just launched it 4 years ago. It's 20,000 crores. It's growing at 60% per annum. Okay. It is a stunning business for the bank. It's coming up there. Our credit card business we launched just 4 years ago. It's already 3.1 million cards, and we have no DSA. We are digital capabilities, and we have digitally originated it. That's a very big one. FASTag, we have 14 or 16 million customers we took in the last 5 years. That's a big franchise the bank is setting up. Cash management is a big franchise setting up. Is coming up very well for the bank. Over 3,000 clients joined the bank in cash management, and we're a new player in that space. Our corporate banking business is growing at 20%, which is excluding infrastructure. So there are fundamental machinery that is moving very strong. Operating profit is growing by 28%. Don't ignore this point. It's a very material point. Operating profit growing 28%. So these are very powerful things coming up. Because we talked of provisions, they kind of get lost in the din. But I believe that when you build a core franchise, in the future quarters, people will get to see the benefit of that.
So all of this non-interest income that you're building from your wealth management and your FASTag business, all of that is going to buttress your future earnings, essentially. That's what you're saying.
Thank you.
All right, sir. Thank you so much, Mr. Vaidyanathan.
Wish you a happy Diwali.
Wish you a happy Diwali to you too.
viewers.
Thank you so much.
Thank you.